right? Now, 20% of self-employed or 20% of businesses fail within the first year, okay? Lenders know this. And so that's why if you're self-employed, we can only use your self-generated income if you've had that business operating for 2 years, right? And we're going to look at that average income. What did it generate you as far as income for those 2 years? And so if it's been operating for 5 years or more, then sometimes in certain circumstances, we can just use the most recent years. But this is why self-employed income gets a little tricky. Another reason is because typically what a self-employed person is generating, right, for their income is not everything that they're reporting to the IRS. And so, like I've said before, we can only use the income that's getting reported. I know, not my rule, but that's just the way that it is, right? Because it kind of makes sense that you can't tell the IRS, I'm only making this much, and then turn around and tell a mortgage lender, oh, look at all the money that I'm making. Can I please have a huge loan? Right? It has to be consistent, and that's where they look at to see if someone's telling the truth or not is their taxes, right? And there's all kinds of great tax preparing scenarios or strategies where they try to report as little as possible, but that cuts against your qualifying income when it comes time to qualify for a loan. And I've seen it happen too many times where somebody's self-employed, they're making all kinds of money, but they're not reporting enough of it, or they're not reporting any of it, and they can't qualify for even a small loan. Those are very difficult conversations to have with somebody. It's like, I know you're making all kinds of money, but for a conventional loan, we can only use what's getting reported on the tax returns. There are, these other types of loan programs like non-QM, they're called, or the non-conventional types of loans, that we can just use bank statements.